Fed Chairman Ben Bernanke says commodity prices may be the key to inflation. Bernanke says the Fed is watching closely to see if those rising commodity costs are having more than a temporary impact on consumer prices. Energy, as we know now, one of the big movers this year. Gasoline has jumped from an average of $3.07 a gallon on January 1st to $3.66 this week. That's largely because oil prices have risen 17%. Stephen Schork says he can't rule out even higher oil prices, but he's betting they don't stay up for long. Stephen is president of the Schork Group. He's with us this morning on the Inside Track. So, Stephen, is it fair to say that you agree with Ben Bernanke that what we're seeing, at the very least in energy prices, is likely to be temporary?
Absolutely. I mean, we're at the point now where consumers just simply cannot pay anymore. We're at the demand point where elasticity is certainly going to wane. As you said, prices are upwards of, on a national average, $3.66 at a Brent crude oil market that is trading upwards of $120. We could look at this point, another 20 to 25 cent raise at the pump this summer. And quite frankly, what recent history teaches us, Americans cannot afford that. They will alter their discretionary behavior when it comes to gasoline this summer.
Okay, on the one hand, you mentioned that key point, elasticity of demand. If consumers see $3.90 or $4 at the pump, they simply won't be pumping as much gas. But is that the only explanation for why oil prices may fall back?
At this point, we also have a hedge fund community, Wall Street community, that is way overextended on their bets on rising oil prices. For instance, speculators on Wall Street now own more sweet barrels of crude oil than are actually sitting in the Strategic Petroleum Reserve, and they own twice as many futures contracts in gasoline than there are at the NYMEX delivery hub in New York Harbor. And we have to keep in mind, supplies are already at or above their historical ranges for this point in the season. So bottom line is we have plenty of supply, and we also have a mechanism now in place that virtually guarantees a decline in demand. In fact, over the last 3 weeks, the DOE's implied demand figures have been falling at a time, mind you, that demand typically picks up at this point. So clearly, consumers are already responding to these high prices.
Stephen, have you any idea what the oil price could be, would be, without the speculative activity?
Oh, absolutely. Before we even heard of the troubles in Libya, oil prices were at $85 a barrel and trending lower. We are up now more than $20 a barrel, so I don't think it is unreasonable to assume we've had a $20 spike based on fear of a contagion spreading in the Middle East. So if we do see less dominoes falling or some easing in the tension there, there's no reason to think oil prices cannot go back. In fact, from a technical perspective, there is a gap between around $85 and $87 in crude oil prices. That gap will eventually get closed. So therefore, yeah, I don't think a $20 plunge in oil prices at this point is an unreasonable expectation.
Wow, that's quite a prediction. Stephen, thanks for joining us. Stephen Schork of the Schork Report.